Welcome everyone to Vested Interest. This is Shane, and this is our weekly portfolio update. We will cover the $2,745 we added in new capital to the portfolio. Crazy market this week. We did go in it several times and add capital. Once after the big drop there on Thursday, a couple times before that. Was planning on just doing the initial buys, but then huge drop again like last week. Maybe we get another one next week, but before we get too far in the video, I would like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. On this channel, we focus on dividend growth investing. It's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing in the portfolio, buying dividend growth stocks on a weekly basis. And I cover those purchases weekly. That's what this video is. We'll cover any dividends received, options I may have been in for the week, all of that out in the open. It is free to see what I'm doing on this channel. But if you would like to help me out, take a couple of seconds. It doesn't cost you any money, but it takes maybe a couple of seconds of your time. Hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Click the notification bell so you're notified whenever I put out any new content. I do this portfolio update series every Sunday. I also do a stock pick of the day video series Monday through Thursday when the market's open. We take a look at a company stock that's pulled back on the day, run it through my screener, see if it makes it onto my watch list. There is also the thanks button down below if anyone would like to buy me a cup of tea. Any money I do make on the channel will be split up in that manner, will be split up between my daughter's custodial accounts. And again, special thank you to everyone who's taken the time to watch, comment, and like the videos. All right, into the video we go. Options again. Another week we threw out I think 5 options this week, but the market's so crazy. I'm trying to be pretty conservative and keep these positions while still collecting options premium. And this year, with the market as crazy it is, big swings up and down, it has not been very good in the options market, at least for me. Maybe you're doing a better job. Let me know in the comment section down below how your options are going, if you do options. Dividends, on the other hand, have been a different story. We've done very well on dividends. Again, another week which we had very good dividends. March 31st, we had 3 companies pay out their last day of the month for a total of $288.42. We do have the drip set on the portfolio, so anytime a position pays out dividends, those dividends go right back in and buy more shares of that same company. So first up, Union Pacific, ticker UNP, out of the industrial sector, paid us $73.45. That $73.45 went right back in and picked up 0.31524 more shares of Union Pacific. Vanguard's total stock market index fund here, VTI, ticker VTI, paid us $65.44. Again, those funds went right back in and picked up more shares of VTI, ticker VTI, 0.24283 more shares there. And last but certainly not least, on the 31st, Schwab Strategic Dividend Growth ETF, ticker SCHD, paid us $149.53. And that $149.53 went right back in and picked up 5.40614 more shares of SCHD. This $288.42 in dividends, the reinvested funds and the shares it picked up added an additional $8.01 in new capital over the next calendar year. Now, we weren't done. We received more dividends from HP Inc., ticker HPQ, out of the information technology sector, paid us $70.64 on the 2nd of April. And again, we have the drip set, so the drips just means the funds go right back in, and that $70.64 bought more shares of HPQ, 2.54834 more shares, and those new shares added an additional $2.99 in passive income over the next calendar year. And if you hear, some people might reference the dividend snowball effect, or some people might call it compounded interest, same, really 2 different descriptors for the same event happening. And basically what all that means is we have shares of HPQ that we've bought, right, with our funds, with my money, with my capital. Those shares pay out dividends, the $70.64. Those dividends, if you have the drip set, go right back in and buy more shares, and those new shares add additional capital income. That is the dividend snowball effect, right? Time is the hill that snowball is rolling down. So the longer I hold HPQ, right, the more this will build itself out. Now, if I add additional capital to HPQ, buying more shares, then this snowball will grow faster and larger and faster and larger. And that is compounded interest in effect. All right, we received our first dividend payment from Vici Properties, ticker VICI, paid us $107.26. This is one of the newer positions in the portfolio, and that $107.26, same thing. We have the drip set on all of our positions. Unfortunately, in my portfolio, it's all or nothing. I have to have all the positions on drip or none of the positions on drip. I'm hopeful that my bank, and I use Ally Bank, in the future opens it up to where you can do individual positions, but they haven't done that yet. But this 107.26 that Vici paid out went right back in, bought more shares of Vici, 3.31052 more shares, and those new shares added an additional $5.72 over the next calendar year. So very good week in dividends, even with all the craziness going on. That is why I like dividend investing. The dividends continue to roll in. And right now, they're buying shares of all of these companies at pretty bargain basement prices, I would say. All right, now after all the dividends received, we'll get into the new capital added. We went in on Monday, same day we tried to throw out some options and added March 31st there, Monday, $1,095.17. With those funds, we picked up one more share of Vale, ticker VALE. This is a mining company out of the materials sector. Picked up that one share at $9.79. Two shares added to our Owens Corning position, ticker OC. This is an industrial company out of the industrial sector, really home building material supplier here. They paid. We picked up two shares there, paid $138.70 per share on that one. HP Inc., ticker HPQ, not only did they pay us dividends, this is one we wanted to focus on for the month of April. Owens Corning was as well, Union Pacific and Google. All of these were really our focus for the month of April. So we picked up 10 more shares of HPQ out of the information technology sector, paid $27.34 per share for those. That's one that dropped down significantly by the end of the week. A lot of these dropped down significantly by the end of the week. Added one share to our Union Pacific Corp position, ticker UMP, picked up that one share at $232.51. And two more shares added to our Alphabet position, ticker GOOGL, at $151.02. This $1,095.17 in new capital we added, the positions it picked up added $24.79 in new capital to the portfolio. We went back in on April 2nd, and really, to be completely honest, I was going to be done investing into the market on April 2nd. We did go back in here again. This was right before the big drop. I had some things going on later in the week that I didn't know if I'd be able to get to my investing. A lot of times I'll do it, for quick 5 minutes at work or something while I'm doing this investing. So didn't think I'd be able to get to it with all that was going on at work. So this was going to be the last investment for the week. We added an additional $445.16, which is right around the $1,500 I typically add. With those funds, we picked up three more shares of Haverty Furniture Company's, ticker HVT. Picked up those shares at $19.82. Four more shares added to our Schwab Strategic Dividend Growth ETF. These are our weekly buys. This one, ticker SCHD and VTI. I buy these every week. 4 shares, 5 shares, 10 shares, whatever. Usually 4 shares or more of SCHD and at least 1 share of VTI. Added those 4 shares of SCHD at $27.73, another one that dropped significantly by the end of the week. And our 1 share of Vanguard's Total Stock Market ETF, ticker VTI, picked up that 1 share at $274.78. The $445.16 we added in new capital, the shares picked up added an additional $11.76 in passive income over the next calendar year. And as I mentioned, huge drop on April 3rd, Thursday, and to be honest with you, another drop on Friday. So I should have just waited till Friday and done my investing all on the same day. But typically I break it up into at least a couple of days. This week, again, big drops Thursday, another big drop Friday, but we went back in on Thursday, took advantage of that drop. I probably should have waited a day, but it is what it is. Added an additional $1,205.78 from some of the capital I have sitting on the sidelines right now. With those funds, we added 4 shares to our Pfizer position, ticker PFE. Picked up those 4 shares at $24.61. Pfizer is out of the healthcare sector. 1 more share to our Owens Corning position, ticker OC. That 1 share we picked up at $137.77. 10 more shares added to our Lam Research Corporation position, ticker LRCX. This is out of the information technology sector. Picked up those 10 shares at $66.65. This one dropped again on Friday. I think it's down in the $50 range, so probably going to be looking to add to this next week. Might be some big changes in the portfolio next week. We'll talk about those here in a minute. And 2 more shares added to our Alphabet position, ticker GOOGL, in the 151 range again, $151.55. With these new shares picked up, we added an additional $20.44 in passive income. Total invested for the week, $2,745.33. This does not include the dividends reinvested. This is just new capital, which added $73.71 in passive income. Now, this does include the passive income added by the dividends as well. All right, quick sector weight update here. Communications currently makes up 11.26 of the portfolio. Consumer discretionary sitting at 1.98. Consumer staples, 8.32% of the pie. Energy at 8.68%. Financials makes up 2.4. Healthcare at 13.71. The largest slice of the pie is healthcare right now anyway. Industrials at 6.47. Technology makes up 13.41%. This will probably be the largest of the pie at some point. And typically by design, well, really, ETFs will be the largest portion of the pie, but for right now, as we add here. Materials makes up 8.44%, utilities makes up 9.43%, REITs and real estate at 5.85%, and again, ETFs eventually will be the largest slice of the pie just by the nature of adding to them every single week, regardless of the market. But right now, it's kind of a tight race, bouncing back and forth between technology and healthcare from week to week. All right, here it is, my portfolio. And again, I think it's important to show this, whether I'm up, whether I'm down, whether I'm floating sideways. So some of you out there who are maybe thinking about investing or looking to get into the market, understand you don't have to be a financial guru to understand this stuff, or to be an investor yourself, not have to pay someone to do it for yourself. You can do it. I do it myself. I am not a guru. I am not educated on finances. I mean, a little bit from the courses I took in college, but it's definitely not what my degree or background is in. My parents do not invest in the market. Neither one of them even graduated high school, to be completely honest. So they definitely don't have an education in any of this, and are relatively poor when it comes to finances overall. But I have learned this along the way, and I show my portfolio every week. I think it's important for those of us in this space talking about finances to do that if we're talking about building out portfolios, so you can see real portfolios built out over time, not just talk about what's good in the market, but what we're actually doing. So I show this every week. And as you can see, I am down again, right? It's been about a 7-8% reversal here over the last couple of weeks. Just the nature of the market currently. So this is the ticker that all of the positions fall in here, or the column that all the tickers fall in here for each position. Total shares in this column, current price as of the close of business on Friday, market price here, average cost per share. This does include reinvested dividends. Purchase price, again, does include reinvested dividends. Total return here, that whether I'm up or down, I'm going to show you, right? There are ups and downs to the market. There are ups and downs to individual positions. That's the nature of investing. It happens. Percent return here, sector, each position falls in here, quarterly, monthly, semi-annual payer, where they pay out lines up here. Current dividend yield as of the close of business on Friday. My yield on cost. Portfolio weighting. So on the previous slide, we saw each individual sector's weighting. This is each individual position's weighting. Estimated annual income, payout months here, dividend growth year over year here. 15% of a 52-week low, and I use this as a high water mark. I want my average cost per share to be at or below 15% of any recent 52-week low. This gives me a high water mark for my average cost per share. That's all I use it for. All right. So currently, total 7,151.272 shares. Really lost a lot of market value in the portfolio over the last week, $324,426.28. I do have $327,186.38 out of pocket. This does include reinvested dividends, so that's not just funds, from my bank account. It does include reinvested dividends, but I consider reinvested dividends out of pocket as well. Because if I didn't have the drip set and if I was using them for bills, it would go into my pocket and then I would spend it on what I want. Right now I have the drip set and it's just getting reinvested, but it's still money out of my pocket, in my opinion. Total return, I am down $2,760.09 currently. Percent return down 0.84%. Current dividend yield is higher than my yield on cost at 4.01%. Yield on cost at 3.976%. Now, I don't focus on these over here. I said that whenever I was up 8, 9%, and I'm going to say it whenever I'm down. Same thing. I don't focus on this. Total return is nice. I like to see that I'm in the green. Not really comfortable seeing in the red, but it happens. And I don't lock in any of these losses or lock in any gains unless I sell out of all the positions in the portfolio. So does this really matter? I'll leave that up to you. This over here, that's why it's circled in red. This is what I focus on. The dividends paid out by all of the different positions in the portfolio. And whenever I say I focus on this, it's really I focus on this because eventually this is what I'm going to turn off the drip and live off of, right? To pay my bills, to retire, maybe to invest into a business, whatever I decide with it. That's why I focus on it, all right? It's not necessarily the end all be all. Dividends are just a byproduct of owning companies, right? I think it's over 400 companies in the S&P 500. The top 500 companies pay out dividends. At some point, most companies pay out dividends because they grow themselves to a point where they don't really have anything else to do with their free cash flow, and they decide to pay out dividends. Some of the biggest, fastest growing companies in the world pay out dividends. Google, Microsoft, Alphabet. I would think these are all still growing companies, but they're still pretty well built out. And it's just the nature of investing. Seems like all companies at some point pay out dividends. NVIDIA even pays out a dividend. So I focus on the dividends because eventually I'm going to live off those dividends, but it is not what I'm looking at whenever I necessarily buy a company. It's just what I'm looking at produced by my overall portfolio. Currently sits at over 13,000. Yes, we finally knocked over that 13,000 hurdle. $13,009.46. Very nice to see, but will it be there long? I don't know. Might be some big changes in the portfolio. Let's talk about those here in a second. Dividend growth year over year at 5.93%. Now, as you can see here, I don't typically have positions highlighted, but I've got 3 positions highlighted here. So I wanted to talk through that to give you an idea of what's going on in my head. HVT, Haverty Furniture Companies, LYB, LyondellBasell, and NTR Nutrien are the 2 that I have highlighted. And you can see they're all 3 down, right? Down 25%. LYB down 31%. This one had a big drop this week. And NTR down 9%. Now, I recently looked at a couple of these companies in the Stock Pick of the Day series. I noticed that their payout ratios were well above 100%, which always concerns me because I have removed companies in the past that have dropped their dividends. If you recall here, I think it was last year, maybe the year before, Leggett and Platt was one in the portfolio, and it right before it actually announced its dividend cut and cut its dividend, I purged that one from the portfolio because of the announcement of the cut dividend. So we took that one out. I can't remember if there was another one. I know Leggett and Platt was one we had in there, but I can't remember if there might have been another one. There might have been one other one. But I know Leggett and Platt was one that we pulled out of the portfolio here a while back because it cut its dividend. 3M was another one a few years back. That would have been 2, maybe 3 years ago now. 3M was the other one. I thought there was one more. So Leggett and Platt and 3M were 2 companies that cut their dividend, and I think both of them, either right before or right after they announced, we purged them from the portfolio. Now these 3, none of them have announced they are cutting their dividend, but that is typically the first step. Their payout ratio goes well over 100%, and then it's 4 or 5 quarters. Now NTR, I think they've run with a over 80%, 90%, sometimes over 100, and then they bounce back under. For the entire 3 years I've held them. But with the market being the way the market is, and with these crazy tariffs and what's going on economically, I'm a little more concerned with companies that have higher payout ratios. I wish I'd have done LYB whenever they were back in the $70 range. But the one reason that Buffett really says there's multiple reasons you can sell a stock, but one of the reasons Buffett puts out there is if you have better opportunities. And I would say there are much better opportunities right now than these 3 companies. And what my thought process is if I sold these 3 companies, yes, I would be locking in a significant amount of losses. 4, 5, 6, 7, almost, $7,800, it looks like, in losses, locked in. But I would be able to reallocate this 10, 19, 25, $26,000 and some change into some of the positions that are down significantly right now that I think are better opportunities. Google, for example. Yes, it has a much lower yield and much lower payout, but I think the upside is far greater than HVT. I think it's far greater than LyondellBasell. I think it's far greater than NTR. Lam Research being down in the $59 range, even in the low 60 range, where I'd like to add to it, below my 23% below my cost basis. I think that is a much better opportunity than HVT, LYB, NTR. I think Owens Corning, even though it is still up at 16% in the $130 range, is a better opportunity than these three. I think SCHD right now is a better opportunity. I think SYY, Cisco, is a better opportunity right now. I think Union Pacific is a better opportunity. I think Vici is a better opportunity. I would like to add more to my Comcast position. I think that's a better opportunity, down 15%. HPQ, I think it's a better opportunity, down in the $22 range. So I'm looking across my portfolio and seeing a lot of other companies that are pulled back, like these three are. I don't have a ton of extra capital right now. I think I've got another, my bonus is coming up on the 17th. I think I've got another $4,000 or $5,000 sitting on the sideline. Really, I've used a lot of my funds sitting on the sideline over the last couple of weeks. But with my bonus coming up, I could add another $4,000 or $5,000 along with this reinvested funds and kind of build this back out. I was doing some math here yesterday while I was reviewing a couple of these. The other reason that's starting to worry me, when I actually look at the fundamentals of the company, LYB's revenue has been declining for the last several years. That concerns me. Haverty Furniture revenue hasn't really been growing the way it should. That concerns me a little bit, especially if we have a slowdown. And Nutrien, same thing. Nutrien looked a lot like LYB, but these are cyclical companies, so I understand that. But if we're in a down cycle, plus the market's crazy, plus we don't know what's going on with tariffs, is the juice worth the squeeze, even though look at their yields. These have really shot up, 9.24%, 6.82%, 4.6%. So I get it. I'm giving up a significant amount of estimated annual income, no doubt about that. $800, $1,200, $1,600, almost $1,700 in estimated annual income. But if I reallocate it over these funds, I can bring down my cost basis in these other areas, right? Add it to some positions I think are, Pfizer. I think Pfizer is a better opportunity than these three. It does have a payout ratio over 100% right now, but I'm not as concerned with it because they have a lot of companies they've recently acquired. And their pipeline for those companies should start producing some benefits here over the next couple of years. So that would be one I would, even though it's above 100% like these three, I'd be willing to hold it. Now, I'm not willing to hold all four, but if it's one of the last ones standing and I reinvested some of that capital over here where I think this is a better opportunity, this one also, yield has shot up to over 7% from the 5.6 it currently sits. So I'm really seriously considering next week, depending on how the week starts out. Now, if these all, skyrocket back up, great. I may still sell them, depending on what is still down. But if the market continues to pull back, or even if it stabilizes and these prices all hold on Monday morning, I may be selling out of HVT, LYB, and NTR, taking that $26,000, probably doing what I've done in the past, focusing on a couple positions and then reallocating those shares across the portfolio. Add that $4,000 from my bonus into the portfolio next week, along with my regular buy for the week. And then when I did the math, I think I would end up right around 12,400, 12,500, 12,500, 12,400. So I would lose a little bit of estimated annual income. I'd be back in the 12,000 range. It's taken me so long to get over this 13,000 range, so I really hesitate to do this. But I also think that these positions are going to rebound faster than HVT, LYB, and NTR. The short story here is I think these three positions are in a potential dividend cut range, and I think there are much better opportunities like Google, like LRCX, like Pfizer, currently than these three. So I may be selling these three, reallocating the funds, locking in the loss. I understand that. So I'll do a little tax loss harvesting. I won't pay any taxes on my dividends received this year if I do that, for sure. I'm almost positive of that. But I would lock in the losses, but I would be able to reallocate the funds across there. Let me know what you think about that. I just, like I said, spent some time yesterday really reviewing the fundamentals, the financials of HVT, LYB, and NTR. LYB, it really concerns me. Like I said, I knew they were a cyclical company whenever I picked them up, and they were in a down. When I bought them 3 years ago, almost 4 years ago now, they had seen 1 year of decline, and my thought was, well, they'll turn it around over the next couple years. They really haven't. They've continued to decline in revenue. If you go look at their revenue, you'll see that. Their margins have kind of declined a little bit. EBITDA has declined a little bit. So I am concerned with this position with such a high current dividend payout yield. Definitely in danger of a dividend cut on that one. Same thing with HVT. The numbers look a little better. The revenue looks a little better than LYB, but still not growing the way I'd like it. And NTR, same thing. It's a cyclical company for sure, but I am concerned with it, as well as the nature of the revenues and margins. I'm also concerned with the tariff issues right now. And I know that may be a short-term thing, but it could really be a detriment to the overall dividend. And I'd hate to hold the company through another dividend downturn with the downturn in the market overall. So, like I said, I think there are better opportunities in the market than these three right now. Google would be one. LRCX would be one. Probably would throw a little bit more in Occidental. Would love to add some more to Owens Corning. Build out that position while it's pulled back significantly. Union Pacific, same thing. Dropped down to 212 from the 230 range. Would love to add some more there. It's right about where I was adding it here, a couple years ago. So would love to build out that position. Vici, love to build out some more of Vici, get it back in the $30 range where it's at. So I'd love to add a little bit more to SCHD right now while it's down 8%, right back in the $25, 20. I think it touched 24 at one point last week, so I could get it for 25, 24, even $26 range and lower my cost basis on this one. I would love to do that. Procter & Gamble, I'd like to double up this position almost while it's pulled back. So a lot of the market is pulled back right now. I don't have a ton of extra funds to build out some of these positions that are pulled back, but I may take these three positions, take the L on them. It's in the nature, it'll be a learning experience. I won't jump into some of these riskier ones for high dividend yield. I mean, they're higher dividend yield now. If I was just chasing dividend yield, I would just really hammer away and throw a bunch of money at these while they're down, but above 100% on their payout ratio. So I am concerned. And I see better opportunities. Like I said, Google at 145 to me is a better buy than HVT at $18.70 or LYB at $57.98 or NTR at $47.43. Let me know what you think in the comment section down below. Are you looking at any positions in your portfolio, seeing better opportunities, maybe locking in some gains or locking in some losses and reallocating funds? That's what I'm seriously considering doing here. I hate to lock in a loss, but I don't want to miss the opportunity to buy Google in the 140 range either, or HPQ at 22, or Oxy at 40, or LRCX at 59 or 60, SCHD 25, 26, SYY back at 71.43, Union Pacific back, 1% off where I was buying it 2 years ago, $212 per share. So better opportunities, Vici back in the $30 range. Better opportunities, in my opinion, than these three. I am very strongly considering, after looking at the financials and fundamentals of the companies here yesterday, whenever I did a deep dive into all three of them, that's what I looked at, and that's what concerned me overall. Not just the payout ratio, not just that they're down, because I'd be adding to companies that are down. Google's down 9%, HPQ is down 20%, right? LRCX is down 23%. So I'd be adding to those positions that are down. Owens Corning's still up. But I was up 90% on this, a month and a half, 2 months ago. So it's down 80% in the last several months. Occidental's down 17%. Love to build this out again, down in the low 40s. Pfizer down 24%. I think this is a better opportunity than these three, even though it's not the best one out of any of the others I've said already. SCHD down 8%. It's a better opportunity. Procter & Gamble still up a little bit. I'd like to add that to that one a little bit. Union Pacific still up 1.97%, though it may be down by the time the market opens on Monday. So that is my thought process. That's what I'm thinking about doing. Let me know what's going on in your portfolio. What dividends paid you out this week? How are you doing in options if you're doing any? What did you buy with these big pullbacks, and how long do you think the market is going to be pulled back? I think we're just getting started here, folks. I think it's going to be a long, protracted downturn. Maybe we still have some downturn to go. So I am going to be trimming these positions, I think, solidifying my portfolio around the best companies that I think remain, and then really build out those positions, even the ones that are down or up slightly still. All right. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the portfolio update here. Let me know what you think of those three positions I'm thinking of selling. Again, it's not just that they're down, it's the fundamentals overall, the reason that they may be down, not just because the overall market is dropping, but the fundamentals of the company seem to be deteriorating. LYB definitely. Go look at LyondellBasell. That one concerns me. 3 consecutive years of dropping revenue, margins kind of decreasing, EBITDA decreasing, not along with the drop, right? So that one definitely concerns me. HVT and NTR very similar. Fundamentals of the company overall don't look that strong. So as we enter this downturn, would it be a better use of those funds in some better positions like Google, like Lam Research? Let me know what you think in the comment section down below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I'm only sharing my opinion. Investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not completely owes your own research and invest based on your situation, circumstances, and select criteria, or see the advice and counsel of a certified financial advisor. Hey, if you made it this far, thanks for watching. Don't forget to subscribe. Hit that like button down below. Share with anyone you think that might find value. Drop a comment and let me know what you think. And click that notification bell on your way out the door.